Hello, everyone. I'm Brian Love, head of banking and fintech with Travillian. Welcome back to the Travillian Next podcast. Today, we're diving into a topic that is reshaping community and regional banking in real time. This M&A tidal wave that seems to be forming after years of pent-up pressure. To help us make sense of what's happening now and what's coming next, we've got some great guests. I'm going to turn it over to the head of bank strategy, Andrew Liesch, to introduce our guests. Hey, Andrew, how are you?
Good. How are you? Thanks, Brian. All right. Yes, we do have two distinguished investment bankers joining us today. We have Dan Flaherty of Janney, Montgomery, Scott, and Gene Katz with D.A. Davidson. Gentlemen, welcome. Thank you for taking the time. Why don't you both lead us off and just tell us what markets do you cover across the country, just to give some background to our audience. Dan, why don't we start with you?
Hello, everyone, and big thank you to Brian and Andrew for having me on and the whole Travillian group. Great partners to have in events like this on the podcast, and look forward to this conversation. I'm a managing director in the investment banking division for Janney, serving banks up and down the East Coast and looking for great ideas and good value plays for investors.
Good morning, and thanks for having me on. I kind of have two different roles at Davidson now. From a historical and legacy perspective, I cover banks from Illinois to the Rockies, and then if you think about kind of north-south axis from Canadian border all the way down to the Mexican border. So that's 12 to 14 states, depending on how you slice and dice this. But then separately, as the head of financial institutions group at Davidson now, you get to see and spend time with other senior bankers in our group, and naturally end up in places far outside that kind of concise geography.
So the impetus for this podcast was really initially to talk about what changes we've seen in due diligence and M&A processes over time. And so why don't we just kick it off with you, Dan? What are you seeing in M&A due diligence now versus, call it, a year ago under the Biden administration, and even earlier in your career? What are some of the big topics that people are focusing on now, and how have those changed?
Yeah, I mean, certainly you have your kind of tried and true areas, credit first and foremost. You're going to start there on diligence. Credit, no matter who the president is or what the economic environment is always paramount to any good due diligence. So you want to make sure credit is certainly first and foremost on your review. I think also, certainly CRE has been a hot button for regulators, making sure that is properly monitored, surveillanced, and reported has been very important. And I think, couple that with, making sure you're in full compliance, making sure the banks are in no regulatory jeopardy is very important. So I think those are the things that people are focusing on. As far as, what's timely in the market right now, obviously it's making sure you're putting together a well-structured deal for investors. So making sure that the earnings are there, the cost saves are there. And I think diligence just in general, as the whole process of bank mergers and the diligence process has changed in the last 5 to 10 years. So it's a constantly ongoing process. It doesn't stop when you ink the deal. It's very fluid, very ongoing, and changing. Certainly, from a process standpoint, it's changed a lot now. It's very remote. Gene will talk about the days we used to have where we used to, have to look at physical loan files and kind of hide in and out of banks at night. That process has changed, which has allowed for a much more thorough virtual process for diligence.
Yeah, I would just add that, a couple of points. So first of all, it seems to me that a number of transactions, more so today than ever before, the diligence process has become more confirmatory in nature than fact-finding. That's number one. Number two, it strikes me that the most important new element in diligence, all of a sudden, is the ability to understand and maybe even confirm once again the cultural fit that you thought was there going in, much more so than any specific tangible element. And as Dan correctly points out, that starts well before the transaction gets put together. The first question here is, well, tell me about the right side of the balance sheet, right? Are those deposits core? Are they sticky? Are they seasoned? Are they granular? How old is this bank? And so that's a really good opportunity to, once again, tell the story, provide some really good facts to support that story. The one thing that has gone away to a certain extent, it seems like, is the compliance side. And I don't mean it's gone away altogether, but the hot buttons related around compliance that we saw for in a number of transactions, but they were front and center in just about every one of them in the last kind of 3-4 years in prior administration, those seem to be taking a little bit less of a front row seat in these deals. But generally, I would say exactly that it's more of a cultural element, and the rest of it becomes confirmatory, is the way I'm kind of seeing the landscape evolve more recently.
So if it's cultural, then what are you seeing, I guess, with respect to the types of, are they all negotiated deals, or are banks being put out to bid? It sounds like you're like the increase in negotiated deals, picking your partners is a much bigger focus right now than just seeing where can I get the best price.
So the answer is yes. Let's just start with that. But again, it depends, right? You got to qualify that. It's a function of geography. It's a function of size. It's a function of whether or not you have a public company and what are some of your obligations in terms of your public institutional shareholders. I would just make an observation that you think about the 4,000 plus banks in the United States today, and people oftentimes forget that the disproportionate percentage of them are in the heartland, right? I mean, you think about the plain states, frankly, geographies I cover. That's where the disproportionate percentage of community banks are in this country. You think about size, an average bank is less than 250 million in size, right? So you think about the coastline, some of the geographies, again, Dan covers, it's a little bit different, right? Larger companies, publicly traded, different subset of buyers. There are certain geographies where, I mean, I hate to say it, but certain banks don't have a buyer anymore. It's just that challenging. So the idea of, in that type of a market, going out to 10, 20, 30 buyers that simply don't exist is nonsense. That being said, there are certain geographies where, yeah, I mean, if you've got a really good bank, and they typically tend to be billion to 10 in size, it seems like, right? You can have 3 to 6 potential acquirers. But even in those situations, it kind of seems to me that, again, the days of true auctions are by and large over. And at best, what you're really striving for is maybe a semi-negotiated transaction where you've got, like I said, at best half a dozen potential names. But even there, if you read enough background to mergers, right, once they get filed in the public transactions, you'll see generally that at the end of the day, there was either one, maybe two, in almost every deal, ultimate bidders when it was all said and done. So that kind of tells you the true story of where things are today.
Certainly,
Yeah,
yeah.
I think, Andrew, discussions, around M&A are so fluid. Like, there's no more like clearly defined, parameters for the M&A discussion. Like boards saying, okay, now we're talking about M&A today, and then in 2 months we're stopping. It's constant, right? You look at these backgrounds of the mergers, which is just like so telling about how banks are sold. You see these conversations are ongoing for a long time. You'll see banker to banker talking, for years. And that goes back to the culture fit and feeling very comfort, so that when you have that diligence, it's confirmatory. Like I said, I think the process for banks merging has dramatically changed from where it was 10 years ago. And part of that is this kind of constant discussion, particularly around public banks, around M&A, what things might look like, how scenarios would play out, so that when it comes to a decision time, it's not discovery, it's confirmatory, right? And I think that is the biggest change that's happened in the last decade in bank M&A.
Got it. Gene also mentioned culture. Is there anything you can do in the due diligence process to make sure the cultures do fit pretty well together? We've seen a lot of deals where it seemed like maybe they did, and then through the integration and realized, it wasn't as good as we thought.
Well, I can start with that one, Gene. I mean, culture's tough, right? You can't touch it, you can't feel it, you can't look at it in a data room. So it's hard to say that there's something specific to do. It either fits or it doesn't. I think it's, some of the tangible things I think are looking at policies. Are policies similar? How is credit underwritten? How do you, looking at maybe how much turnover you have in your employee base? How are the employees treated? Things like his pay scale, who's rewarded. I mean, those are some of the tangible things you could put your finger on culture, but nothing beats face-to-face time with, respective leadership teams.
Yeah. Got it. So I think, again, just to add some examples, as I think about culture, I mean, oftentimes, as we all know, there's two different types of banks, generally speaking. There are the traditional plain vanilla community banks. Some of them are in big markets, some are in really small markets. And then there's kind of unique business-focused entities, small or large, right? And it strikes me once again that in the former, there's always discussion about, hey, culture to us oftentimes means being loyal to this community, taking care of the civic causes in this community. And whenever you see a transaction occur, We've seen plenty of examples in years past where that goes away. And once that occurs, as an example, um, is that bank really, really culturally supportive of its legacy? Probably not, right? Certainly not to the same extent. But nor do I typically expect that to continue occurring, right? On the larger deals, and I say larger again, the business focused institutions, it's a little bit different because there, again, you really, the unique element there are the teams you've got, really, right? Well, we say it's about people, but in those banks, it's really about talent, right? And so, what can you do from a cultural perspective, whether that's compensation, whether that's stock ownership, right? Whatever it is, what can you do to retain the team, make them as excited about the combined organization, the path forward? Because if you're not, then it's probably not going to work out. And so again, is that culture? To me, it is just because of how the bank is constructed. To some folks, it may not really be even cultural ultimately in those types of organizations.
Got it. Want to shift gears a little bit to the regulatory environment. Deals are closing a lot faster now under Trump than they were under the Biden administration. What are you hearing from regulators when it comes to M&A? Has their tone changed at all?
Well, certainly, what we've seen is they're more receptive. I think the days to close is shrinking, no doubt. So I sense that there is a feeling that the environment for M&A is as good as it's been in a long time, certainly from a regulatory perspective. Regulators are still looking at deals. They're still getting very cautious about approving deals. I think what the public doesn't realize too, when they look at this kind of stat of days to deal, there's so much work done with the regulators before you do an announcement. Banking in general has some filters around whether a deal is going to get regulatory approval. Every bank in the United States has a camel rating, right? I mean, certain camel ratings equate to whether or not you're going to get approved for a transaction. They have ongoing relationships with regulators. They often do flyby meetings before they announce a deal. So I think the industry has done a better job getting in front of regulators before a deal is announced, which has helped that. But I also think the regulators are more conducive right now to approvals.
Yeah, I think we've seen some deals in the past 12 months under the current administration um, that have been certainly the filings that occurred and the approvals they've received, I'd say in record time, even in my career, forget about, versus the last 5 or 10 years. I'm just saying overall. So I think that's a pretty positive impetus for transactions. The one piece we've not really talked as much about, and I'm somewhat surprised, maybe that's a good sign as well, is the HHI element, right? And so you've got some, again, smaller banks in smaller communities where, from a historical perspective, that Hirschman-Herfindahl index criteria, which is the measurement for competitiveness in that market, at times will necessitate that you cannot do an in-market transaction. And the reality, the practical reality, is that the only buyer oftentimes is the community bank across the street or the town over, right? And so, it's a catch-22 because what maybe the lightning rod for that transaction moving forward, it has to get done for a variety of reasons, right? And yet your only buyer, the only interested buyer, is the one that under the credit formula simply can't do it. And so the fact that those deals are not being turned down as of yet, or we're not going back to the drawing board, I think that's a positive element too. Again, only really impacts smaller banks and smaller markets disproportionately, but I think that's a good sign.
What about credit unions? Oh, yeah, go ahead, Brian.
I was just on the regulatory front. I'm just curious. Two words come to mind: urgency, opportunity. The regulatory environment creates maybe one or the other, or maybe both. Do you agree with that, guys?
Yeah, definitely. I mean, certainly, no one wants to go backwards in the regulatory relationship, so it takes urgency. If you're struggling or you have an order, I mean, certainly we've seen banks pursue M&A to kind of solve an order, solve a regulatory issue with someone bigger, stronger, and a better regulatory relationship. As far as opportunity, I mean, I think opportunities are really strong. I think there's a lot of opportunity for the bigger banks, right, that had more headwinds with getting deals approved and through the system. Certainly right now, I think that is as as attractive as it's ever been for the bigger banks.
So another way to think about this, Brian, is in our industry, we always had a group of folks who have been acquisitive by nature, right? I mean, that's just part of it's almost a business line for a number of these banks, community bank M&A. And then if you look back, if you were to talk to CEO of Bank XYZ, they'd say to you, look, I've got my tier one list, and I don't know if I ought to go down the path of doing this particular transaction because I can't control whether or not a name on my tier one list is going to pop up. And the situation I don't want to be in is to find out that as we're doing this deal, that one comes up, we can't do both, right? And so the change in the narrative, and this goes back to the being opportunistic, is that when you're talking to the same CEOs, all of a sudden, what you're hearing from them is that the idea of doing one in a calendar year is not the outer governor anymore, right? It's, look, we can do two back to back if the stars align the right way. And that's the one piece that has changed from what you've seen in the recent past.
Interesting. Andrew.
Yeah, no, just wanted to go into credit unions. How's that shaping the regulatory discussion with acquirers? I think we're maybe it's one or two deals away from either tying last year or exceeding last year of a credit union buying bank. Is that trend going to continue?
Yeah, so I mean, I'm happy to take that one first. I've done enough of these. It's always an interesting process. It's for those who've not worked in a transaction opposite a credit union buyer, boy, is it a different type of a process, both in terms of kind of what they look at, how they think about what's important, the understandings and assumptions about timelines, probably more than anything else. My gut tells me when you really get down to it and ask why are these deals happening, folks almost always focus from the perspective of, well, credit unions when they get larger, will they be more bank-like, and all of those things are probably true on the margin, but folks rarely ask why are banks choosing to sell the credit union, right? And so one part is just valuation. Two is the cash buyers. But three, again, there are certain transactions in certain geographies where, just like my prior discussion example in HHI and the community bank next door, the credit union may be the only buyer. Mm-hmm. And so again, it's back to what's happening in M&A, and is it going to continue? Is it going to accelerate? As it relates specifically to credit unions, my gut tells me we're in 26, at least we're in for more of the same. It's just, those deals really take a long time to put together. And here's the other thing too. I mean, the list of kind of really sizable credit unions, right? I mean, that's a pretty short list. Again, people don't realize how few credit unions are north of a $10 billion threshold. So you think about their ability to acquire a bank from a relative size discussion. It's not going to be $5 billion banks selling to credit unions. That's just not where they play.
Yeah, I think credit unions, are a very viable cash buyer for smaller community banks. I think that's going to continue. I know a lot of the banking associations, want to limit the ability of credit unions to buy banks. I was never a proponent of limiting options for shareholders. I always felt like the answer was make it easier for other banks to buy banks if we wanted to kind of keep the bank-to-bank M&A. And I think that's happened. We just talked about regulatory approval and the environment getting better. So I think that's helpful. But, I think they're here to stay as a very credible cash buyer. And like Gene said, a lot of times they are the only option. And if they can provide an exit for shareholders that are stuck, I think banks will continue to look at them as a favorable partner.
If I can just add real quick, one of the things that people don't really realize is where the credit unions really have a financial advantage, right, is when the seller's an S corp. Because the double taxation element, there's a gross up that needs to occur at some level. And so when you talk about public companies selling, again, if the size fits and geography fits, and there's credit unions, just recognize that in a C corp situation, that credit union is going to have to come up with X% more. And it's, just think about what the tax rate is, right? Corporate tax rate. And in order to be on par with a bank buyer.
I know some states have, kind of pushed back to the point where those deals can't even be done in those states.
Right.
I wonder if that trend continues. There's just a lot of push and pull from different parties of interest. I wonder how that plays out.
Well, that's, again, just to be clear, that typically only applies to state charter banks in those geographies you're alluding to. So the national banks, even in those states, can sell typically to a federal credit union. There are some states that are now limiting state charter credit unions' ability to buy in the same states,
Right.
right? So, I mean, it seems to be narrowing, the optionality that you're talking about. But again, it just strikes me that this will continue.
Yeah.
Makes sense.
The other,
Yeah, go ahead,
Andrew,
Frank.
the other question I was going to mention here, just along the lines of, other suitors for banks, private investors, fintechs. A lot of our attorney friends are talking about fintechs trying to get their own bank charters, either by way of de novo or buying an existing franchise. What are you seeing, Gene and Dan, on those fronts?
I again, you think about the transactions you've worked with in the past, and where Davidson have been blessed to have done a couple of these that were disproportionately kind of fintechish focused buyings that have been acquired by fintechish partners. I worked at a bank called Vaz Bank in Tulsa, Oklahoma, which was recapitalized / acquired, depending how you want to think about that process, by a well-known fintech investors and from years prior. But it's a traditional community bank that had some history in that space. And there's other ones. We represent Lead Bank once again in Kansas City historically, that had elements of that, and a few other ones. And I would just say that again, that trend, whether that's the institutional, so entities that are fintechs themselves, or investors that are coming from the fintech world, those types of deals, there's not going to be a lot of them, but the good ones are going to get done.
Because what are you hearing specifically from the banks right now, from the banks that you're calling on? Are some of them telling you, all right, we need scale right now, let's go get something done? Or, and I'm sure there's some sellers as well that's like, okay, yep, our board we have several guys approaching either retirement age or they're well past retirement age. We need to find a buyer and hit the easy button. Dan, why don't you lead us off there? What's the most common theme from the banks you're talking to?
Well, Andrew, there is no easy button for any of those alternatives, right?
Yeah.
Gene and I do our best to make it an easy button, but it can always be difficult. In the industry, there's definitely a sense or a tone that if you are going to transact, now is the window is open. And transact can be a sale, an acquisition, a merger of equals, another strategic initiative. We've seen balance sheet restructures. You're going to lift out, you're going to branch. Whatever in your strategic plans you wanted to execute, I definitely feel the pulse of the industry is let's go do it. Let's go do it now. Things are good, generally good. The administration and regulatory environment is conducive to these things. Let's do it. And so I think you're seeing banks evaluate it. So I think the appetite is there. Execution, has speed bumps, right? So not everything's getting executed, but I definitely think there is a strong desire to transact and execute, over the next 2 years.
Yeah, so I would just add and maybe decipher this in two different ways. When you think about the buyers, right? Again, the mid-sized publicly traded buyers. I mean, I would generally echo Dan's sentiment that the theme you hear the most is, hey, the window is open, things feel good, they look good. If the opportunity presents itself, we ought to try to do it. On the sell side, I always go back to the question of why do people sell, right, in the first place? And even there, you have to kind of look at the two different worlds because, as I said earlier, you really think about the landscape of banks, whether it's less than $1 billion, less than 10 billion, however you want to think about it. Disproportionate percentage of them, once again, are privately owned, right? And so when I think about my own career, and it's not a perfect remuneration, but it's probably not far off. If I were to handicap why people have sold in those kind of private banks, once again, I'd say it's down to three reasons, disproportionately almost. It's age, it's lack of succession, and it ultimately is need for liquidity, right? Mm-hmm. It's rare that somebody wakes up one day and says, hey, this may be the right time to sell because I got a $1.5 offer or whatever the number may be, right? It almost never happens that way. So those three themes, cycle in, cycle out, they're still there. And so I think those transactions will be, we'll be executing on those regardless. But I think to Dan's point, once again, this environment is making it easier, A, to execute, and B, to provide additional optionality for those sellers. That's the key.
We've seen some deals that, in theory, look pretty logical and make sense, make the acquirer better, give them a new market maybe. But the stock reactions have been almost uniformly negative. What gets that to change? I mean, are investors just too negative on deals right now? Or, I mean, if you look out a year and the accretion, yeah, maybe it looks pretty good. Do investors just not want to wait that time period? Like, what are you hearing? And what's going on in the boardrooms when you're discussing these deals and potential stock reactions with the management?
Yeah, well, one of the most important themes I would tell you again from the sell side. So the second part of your question, one of the most important things I feel that an investment banker can and should say to the board, especially when you're talking about a stock transaction, disproportionately stock, once again, it's more of a reinvestment dialogue, is the idea that, hey, this deal's got to work for everyone, right? I mean, it's got to be a good transaction for you as my client, but the market's got to receive it well. And so the way to think about this is you got to be making this decision. Well, you're making for your shareholders. You also have to be almost automatically from day one thinking as if you're the buyer shareholder as well, because effectively you are in a fixed exchange ratio transaction, right? Mm-hmm. So is there more to come? Is this a shift of strategy? You know, an institutional investor may be in that stock because it's as steady as it goes and there's not a lot of unexpected turns, and all of a sudden this is unexpected. And it's a deal that's been announced that they did not model out for. So, you know, that happened. There's no question about that. The second part is relative pricing, right? I mean, we've seen some deals that, you know, on one hand appear to be cheaply priced, but then you start thinking about whether it's the old payback discussion or the pay to trade ratio. And they, you know, again, while the nominal value may seem low, the all-in relative value is pretty full, in my opinion, right? So there's two really different dialogues that have to occur on the other side of this.
Yeah, it feels like there's a disproportionate amount of negative feedback for the buyer than there is reward on these deals. It's you know, I think it can be frustrating because the investors certainly want the banks to sell and to exit, right? And so the investors should be rewarding the acquirers, and it doesn't seem like that's their day one. But I think that the real good acquirers do a good job of thinking about where the stock price is in 30 days, 90 days, in a year, and don't get too hung up with the, you know, day 1 through 7, the first week or two of what the stock is going to do as being a true measurement of success on the deal. That can also be a tough conversation in the seller's room to say, hey, we're going to take this stock valued at $10 and tomorrow it might be $9.25 just because they're acquiring us, right? I mean, that does happen on the sell side. So to Gene's point about deals being well received by the market, I think that conversation, you know, is more dominant than it's ever been in the past, right? There's a lot more focus on value, what future value is, not necessarily what the day one country club price is, if you will. So definitely a shift in deal structure and how deals are thought about. But yeah, it would be nice to see investors reward, you know, well-structured deals more than they are, but that's okay. It's just a function of the market. And certainly at the bigger bank level, there seems to be a lot more scrutiny, pressure on doing the right acquisition. You know, we're seeing some of the larger banks get a lot of pushback from investor groups about not doing deals. And some of these banks now are coming out in the last few weeks saying, hey, we're committed to not doing a deal. To Gene's point, they're either broadcasting themselves that they are or aren't a buyer, so investors know they're not caught by surprise if they do something. So I think that's been a really interesting trend. I haven't seen that in the past.
Just the nature of the environment, right, guys? In the last 3 years, and these are rough numbers, but 75% of all deals have either been in the form of stock or cash on stock, which typically means the buyer's a public company, right? Mm-hmm. You turn the clock back, you know, before pandemic, and the numbers were quite different. There were years where more than half the deals were all cash deals at times, right? And so what does that tell you? Well, it just tells me that there's just more noise around the fact that we've got fewer private deals occurring where you're just not going to get that type of reaction because there's none to be had. And then you've got, you know, public deals where they're just a greater percentage of the pie all of a sudden. And so you've got ability to critique and ask tough questions and pass judgment.
Brian, I want to pass it off to you. Any questions on talent or succession planning you want to ask these guys?
Well, I think both of you have mentioned succession as a driver for M&A. It's historically been one. I'm kind of wondering, is there like a new norm retirement age that you're hearing? Or is there some sort of catalyst for an expedited, you know, we got to sell. Like I'm fatigued from all this roller coaster of the last, you know, decade or so. are you seeing reactivity? Are you seeing proactivity on that succession piece? And by the way, succession can be board, can be executive, but it's also shareholder, right? So love for you to speak to all of it.
So there were banks back in the day, thrifts maybe even a better example, right? Where you kind of knew that the management team would convert, they would spend the next 3 years buying their stock back. And when they got to that kind of that 65, 66, 67 year age threshold, it was higher probability than usual that that company would typically look to sell. And so you go back to pre-Great Recession, right? And you think about that type of a situation, that type of a bank, that type of an age bracket. And those management teams have lived through, not, if they're still around, have lived not through one, not two, three, and maybe even in some people's eyes, four black swan events, right? And so at some point, you're not just 20 years older and you're 20 years past when you wanted to execute on something, but you've been through so many roller coasters on this thing that emotionally, you just may not want to sign up for another one because you just, you simply can't. And so in those situations, it's not as much about talent. It's about the fact that, hey, we're done. We're just done.
Yeah.
We should have been done 20 years ago. We should have been done 10 years ago. We should have been done 3 years ago. But we're really done at this point. And so is there a talent drain there? Absolutely. One of the biggest issues you hear when you go, again, it's a function of geography and size. And I've mentioned this multiple times in this podcast. But if you think about a couple of $100 million bank in rural, call it downstate Illinois, right? To use the state I live in as an example, you're going to have a really hard time finding certain skill sets that are absolutely necessary today at the C-suite at a bank. And you're going to have just as hard of a time finding really good board members, with knowledge and history of being a community bank director, right? But also kind of required skill sets of what some of the skill sets that are required now to be a board member. Because before, again, traditional board members were, the former mayor, the guy who owns the local hardware store, right? Just kind of local guys. It was more focused on civic responsibility and business development. One of the things that I think has changed is the fact that what's expected of a director now. And it's not that that's not important, but it's the execution risk discussion. It's the control function element, right? That has become much more important in director today than I feel like it's ever been. And many of those are just not available in those geographies.
I think from my perspective as a recruiter, 90% of the board engagements are looking for people with bank experience, financial risk, technology, that experience. And a lot of banks in the middle of nowhere are willing to have people in their general region, join a board meeting via Zoom these days rather than have to truck to wherever they are. So good point there, Gene. Dan, I wanted to make sure you got a chance to respond.
Thanks. Yeah, I think succession is just a huge issue. It's not just around the CEO, Brian, you talked about it, certainly with the shareholders. I think it's succession of customers, right? As people sell their businesses and move on, that's important. I think, succession of employees is very important. And I think where succession in talent impacts M&A more than people realize is actually not the retirement of the CEO, but retirement of key people around the CEO. So whether that be a chief lender, a CFO who's been, part of the team for a long time, and then that CEO saying, hey, I'm alone here. I don't have this person, this guy, this gal that was my number two person that I went through with everything I was in the foxhole with, right? I think those retirements and departures are more impactful on M&A because then they push the CEO to think about a sale than the actual retirement of the CEO, because the CEO has already kind of retired in his or her mind and moved on. I think it's the retirements around the CEO, and that can be a board member, a key board member, a previous CEO who's on as a chair. So I think it's those retirements to be on the lookout for that are more impactful for leading a company to M&A than actually the CEO.
And hence, internal training and really trying to develop people from within. We're just huge proponents of it. It's so much easier to hand the torch to someone who knows your culture, knows where the skeletons are, so to speak, than to externally bring someone in, which is also a great strategy, but can sometimes create more problems. But great responses there, guys. I mean, on the talent side, the only other question I had to ask is, are there times where the talent of the bank you're looking at acquiring is the key driver of what you're trying to get? Are there any specific examples of that? And that stability, or that new, better CFO, or a better, market executive in a specific city, something like that. I'd love to hear about any stories you have there.
Well, I won't tell you stories, but I give you two different types of situations where I think you see this a lot, right? And so you see this in merger of equals, and oftentimes a smaller bank acquisition where kind of the larger of the two, if you want to call it, has a retiring management team, a retiring C-suite, retiring CO, perhaps, whatever it may be, right? But part of the reason the transaction from a social perspective is being able to get consummated and put together is the fact that that up-and-coming CEO from the other side, which may be, again, smaller in size, and typically wouldn't necessarily get the top seat, is the individual that this team would, the larger bank's board would want to hire for that spot, right? And so it's kind of solving your issue via M&A. But I think what you see more of actually is not even that. And I'll give you a good example is, think about a larger community bank in rural part of any state that wakes up one day and says, hey, we want to go to the big metro. And we've seen stories, again, harken back to the days of 2008, 2009, where banks did that across the country and found out that they were, frankly, the bank of last resort in that particular geography when they did that, right? And many of those banks, unfortunately, failed. But what's happening today is there are some really, really good banks. And some, again, I'm not talking about any specific geography, but this is a generalized comment. Where you've got situations where that larger bank would say, rather than building from scratch and not know what exactly we're doing, is there a bank to buy, preferably with stock, if possible, to partner with them? But if it has to be cash, then so be it, right? To acquire the local C&I or commercial lending expertise, whatever the case may be, right? So that the risk for us is lower than what others had done organically before. And I think you have seen, and you're going to continue to see a lot more of that. Again, it's all relative when I say a lot, but I think you're going to see plenty of situations where that know-how, that knowledge, that's the franchise value as we talk about, right? That particular organization has in the eyes of that larger, albeit probably more so rural type of an organization.
Yeah, I think we see it a lot at the market leadership level, versus, grow or buy. That's always been a discussion, in banking. And I think ultimately that's where you pick up a lot of talent is, on that, in the field talent is certainly where we see it a lot. I mean, certainly CEOs can be acquired, but I think you see it even more so on the, on the operator level.
One final question here before we wrap up. If you look back on M&A 1 year from now, what will 2026 have given us? More deals, fewer deals, larger deals, smaller deals? What are you seeing in your pipelines? What do you think we're going to see?
I'd say steady. I think you're going to see steady activity, more of the same, steady uptick. And I think people looking to transact.
Yeah. So Dan stole my the word I was going to lead with, steady. I think it's going to be more of the same. I mean, I think this year, I don't have the exact numbers, but I think we're going to end up at probably plus or minus 175 M&A transactions, Dan. Does that sound about right? I think it'll be the second highest year since pandemic. Certainly better than 2024, and certainly materially better than 23 on the M&A front. I do think that, again, there's going to be incrementally more all cash deals as the private guys come back in. Think about one of the limiting factors in that space has been the cost of capital, which disproportionately had been the borrowing costs in the sub-debt markets. As those have stabilized and have continued slowly come down, there is both the lower execution risk and much better known pricing on that. So I think, again, you're going to see a little bit more of that. I think you're going to continue to see probably similar number of larger deals. I mean, I don't see that going away, and I certainly don't see that doubling or anything like that. It's just fewer banks of certain size. So, would I be surprised if another, 3 to 4% of the industry merged next year, which is more or less in line with historical averages? Not at all. Perhaps even slightly higher on a percentage basis. But one of the things that does come down to ultimately is where the bank stocks trade, right? because if the market is not rewarding the bank trade, it becomes materially harder to execute on those deals.
Yep.
Great.
Yeah. Dan and Gene, thank you so much for your time. By the way, you go way back with Dave Yankowski, our managing partner here. And we really, really want to just express the gratitude for not only joining us, but sometimes you've allowed us to help some of your clients. And that is really the way this all works so well together. We're big fans of yours and others of your brethren. And I just wanted to thank you for that. And thank you both for adding some clarity to this fast-moving M&A landscape. And here's to a holiday season where the only thing getting merged is your eggnog with a little bourbon. Cheers.
Awesome.
Thanks, guys. Really appreciate it.